Welcome back, everyone, to another episode of the Dental Boardroom Podcast. So I am carrying on my episodes on what is cost segregation analysis. And have many doctors brought this up over the years. It is a legitimate strategy, 100% legitimate strategy. However, it's not always the best strategy. It is commonly a great strategy. And I want you to understand at least the basic terms and definitions and concepts of what a cost segregation analysis is, so you can bring it up with your CPA or financial advisor, many of whom will not volunteer this. It's more work for them, and that extra work doesn't always translate into more income for them. And a lot of times your financial advisors or your CPAs are just so dang busy that they don't get into good strategizing. And this is a good strategy. Okay, what I want to talk about as we kick off this episode on cost segregation is a critical warning about the building. There have emerged a number of times as a prospect comes in and gives me their financials that I learn that they put their building inside of their dental practice entity, usually an S-Corporation. They put it inside their S-Corporation. I cannot tell you how terrible advice they received by whoever recommended that. There are 4 reasons why I'm going to state that this is an absolute terrible idea to have your dental corporation buy and own your building instead of a separate entity outside of your dental corporation. The first one is extracting your building out of your S corporation is a nightmare. Pulling real estate out of an S corporation later is treated as a taxable distribution at the fair market value of that building. So let's say 10 years ago you bought your building. You got bad advice or no advice at all, and you thought, well, it's my dental practice. I'm just going to have one tax ID. Maybe I'll save a little bit of tax filing every year by having my practice entity own my building. The problem is that now your building, your practice has your dental office as an asset. It's checking accounts, it's chairs, it's got your credit card accounts, the loans to buy the practice, loans for other things. And then on it, it also has the building as an asset and the building loan as a liability. It's all one balance sheet for the doctor. It's one tax ID, one balance sheet. And if you go to sell your practice and you don't want to sell your building, well, that's a problem. You have to extract your building out of your practice. There are various tax reasons why you want these things completely separate. And then if you did that, 10 years goes by and somebody tells you, hey, doc, you really got to pull your S-Corp out. Now you got to bite the bullet, and let's say it's gone up from you bought it for $1 million, now it's at $1.5 million. And you pull it out, fair market value is $500,000 more. You probably already depreciated some of it. You're going to end up paying taxes on that of somewhere around $500,000 to $700,000 is what I would estimate. And that might end up being $200,000 to $250,000. Imagine right now I say, hey, doc, go look in your bank accounts, go look in your investment accounts. You got to come up with $250,000. Yeah, you're going to say, screw that, Wes. I'm just going to keep it in my practice. Fine, but you're going to punt that down the road, and you're going to bite that bullet later. So this is why at the onset you absolutely don't want your building held in your S corporation. All right. So extraction is a tax nightmare. That's number 1. Number 2 is the liability exposure. Having your building inside your operating entity means it's exposed to malpractice, employment disputes, and litigation. So a separate LLC for your building creates a firewall. Number 3, financing complications. Lenders prefer to underwrite commercial real estate separately. A standalone LLC with its own balance sheet is cleaner for refinancing or equity lines. Banks really prefer to have these two things separate because it is a different type of loan to a dental practice for operations like buying patient records from someone down the street, or buying the practice, or buying a CAD cam and taking out a loan. They have different underwriting criteria for that than buying a building.
Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do two things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of Practice Orbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to Practice Orbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system, from listing the practice to NDA to LOI and finally to closing the deal. Create your free account today at www.practiceorbit.com.
Buying a building, for example, they typically want cash down. The building is a collateralized asset, where if you buy other things in your practice, they're not really collateralized assets. They're cash flow based assets. And those are two very different types of loans at the bank: cash flow based loans versus asset backed loans. And real estate is always an asset backed loan, and typically can come with a lower interest rate. So that's number three. It creates financing complications to own your building inside of your dental S corporation. And number four, state licensing compliance. In many states, non-dentists cannot own a dental professional corporation. Keeping real estate in a separate LLC keeps ownership clean and compliant. So if you want to go sell your building later to somebody who is not a dentist, and if the building is held inside of your corporation, that can become quite complicated. Keep it in your LLC. It makes it so much cleaner from a state licensing and selling standpoint. All right, so the right answer, a single member LLC that owns only the real estate. Clean, simple, defensible. Now, if you are married, I often will have a spouse on that LLC as well. Not required, but let's say your spouse is a dentist. This is not uncommon at all in dentistry. And you're married, and maybe you're in a community property state, as many are, and you own that LLC together that holds the building. You can still call that essentially what's called a single member LLC, because the spouses can be treated as one person. Not all states allow this. Like Hawaii doesn't, I know offhand. So you got to speak with an attorney to determine, and you can, I'm sure, AI this. Does your state allow spouses to own an LLC, what's called a disregarded LLC, and be treated as if they're one person? Because as soon as it's two people, then the IRS does not allow you to hold it as what's called a disregarded LLC. You have to hold it as a partnership, and that creates a lot more complications. If you actually have a dental partner or somebody else who owns the building with you that is not your spouse, then inevitably you want to be a partnership, an LLC that files as a partnership. Now, you're probably a little bit confused because I didn't clarify one thing. What is a disregarded LLC? A disregarded LLC is an LLC that files as if it files a tax return as if the LLC structure never existed. You heard me say on my last episode, on many episodes, that LLCs do not exist to the IRS. You cannot file an LLC tax return. It doesn't exist. The LLC has to decide when it files a tax return, is it going to file directly as if owned by the owner of the building directly in his or her name with his or her social security number? Or is it going to file as a partnership with a separate tax ID? Or is it going to file as a corporation, which you don't want to do here? So a disregarded LLC is simply an LLC that at the state level protects you from liability. That's good. But at the federal level, it doesn't exist, and you have to file it directly. This is what I always recommend, directly on your 1040 personal tax return, what's called Schedule E, page 1. Schedule E, page 1. And it therefore, that has the lowest cost associated with it. Because it's marginal extra work on the 1040 tax return as long as good accounting is done for that LLC. It's marginal extra work, meaning it's pretty low work to file the income and expenses of your building LLC directly on your 1040 tax return. If it's not disregarded and therefore it's filing as a partnership or a corporation, you have a whole separate tax return. And now it goes on Schedule E, page 2. Page 2 is where all your K-1 income comes from. That's your S-Corporation for your dental practice, or any other type of entity that is an S-Corporation or a partnership that flows its profits through to you on your 1040 and doesn't file its own tax return and pay taxes on that separately. So, disregarded LLC, that is the operative word. Those are the operative words there. You want to be a single member disregarded LLC that owns your building whenever and wherever possible. I can't emphasize that enough. Okay, let's now go on to, now we've outlined the critical warnings here of never holding your building inside your S corporation. Let's go on to segment 5. And again, if you're watching this on YouTube, you will see a diagram on my screen, and I will narrate this diagram. This is a two-entity strategy. And the structure that works, it looks like this. On the top is a box, and it says the dentist. That's you. And underneath it, it says the personal return. You, as an individual, have to file a 1040 tax return. The only time you don't have to file a 1040 tax return is when your income is so low that you owe no taxes, zero taxes. And so if your income was $5,000 for the year, guess what? You're not going to have to pay any taxes on that. And therefore, you don't even need to file a tax return. Now, most people had remitted some taxes on their W-2, so they file anyways to try to get their money back, get a refund. But you, if you're a dentist and you're anywhere in a modestly profitable place, you are absolutely 100% going to have to file a 1040 tax return. It goes without saying. Now, on the bottom left is your S corporation, your dental S corporation. This owns the operating entity known as your dental practice. This generates all clinical revenue. It pays expenses, labs, labor, supply, facility, marketing, admin. In the facility category, you have rent. You have rent. And if you don't own your building, that's going to some dude out there who owns the building and is building their own net worth. And for you, it's a tax-deductible expense, but it's not building any wealth for you to do that. If you own your building, then great, you're paying rent to yourself. That's awesome. And this Dental S Corporation also then issues you a K-1 at the end of the year. And the K-1 shows the net profits to your dental practice. After all expenses, what's left, and that goes out on your personal 1040 in the box above, and that's where you recognize that as taxable income. Now, on the right-hand side, you have the real estate LLC. This is the disregarded LLC. This owns the building. It collects rent from your S corporation. It deducts mortgage interest and other expenses for the building. And this is where you could do a cost segregation depreciation analysis to shelter rental income. Now, these two boxes on the bottom left is your dental S corp, on the bottom right is your real estate. They have a relationship. And the relationship is the dental S corp pays rent over to the to the real estate LLC, and the real estate LLC has a lease signed by you, the tenant, from your S corporation. Your S corporation is the tenant, not you personally. Your S corporation is the tenant of the building, paying that rent to the LLC. The rent that reduces, and this rent that it goes from your S-Corp to your LLC, this reduces your K-1 from your S-Corporation, because more rent is more expense. More expense means lower profit. Lower profit means lower K-1 taxable income that flows up to your 1040 tax return. So now the thing is, though, is if your rent, let's say it's $100,000, goes to your real estate LLC, you get a $100,000 deduction on your S corporation, and your K-1 goes down by $100,000, and you pay taxes on $100,000 less than if you didn't pay rent. That's good. You may have saved $30,000, $40,000 right there because of rent expense. However, the money goes over to your rental real estate LLC, and you have $100,000 of income over there. And these things are just a teeter-totter. More rent from your dental practice means a lower taxable income. It also means higher income in your real estate LLC, and you have to pay taxes on income in your real estate LLC in the same way that you pay taxes coming out of your dental corporation. So you're going to ask, well, how is it really benefiting me then if I get a $100,000 deduction in rent in my dental corporation, but I have to recognize $100,000 of income in my real estate LLC? Well, the reason why is because you have all these expenses in your real estate LLC that get to reduce or erode that $100,000 of income, potentially bringing it down to zero or even into the negative territory. What are some of your expenses? Well, you have mortgage interest. You have, maybe there's certain other expenses. Maybe you're doing a rebuild on the roof, or you're painting walls. Now, a lot of the maintenance stuff can and should be paid out of your S corporation as the tenant. And leases will identify what does the landlord pay and what does the tenant pay. And a lot of the smaller stuff is paid by the tenant. That's your S corporation. But there are bigger things, like maybe getting a new HVAC system. That is paid out of the real estate LLC. Now, this is where you really get the benefit, is you do a cost segregation analysis and you pump up the depreciation. You front load that depreciation such that 100% of that $100,000 of rental income gets reduced down to zero and even creates that loss I talked about. That's the strategy there. All right, let's look at I want to get to an example here shortly. But before we do, because one of the things I bet you're asking is, well, how much can we get away with? How much rent can I pay from my corporation to my billing LLC in order to maximize my tax benefits? I mean, if you're telling me, Wes, that I get to deduct $400,000 to $500,000 of my $2 million building in year one, if I do a cost seg paired up with a bonus depreciation, why don't I just jack my rent all the way up to $400,000 or $500,000? Well, that's a good question, and I'm going to address that here shortly, either in this episode or a subsequent episode. But before I do, I just want to cover the landscape of these various concepts related to this so that I can then get to that crystal clear example and discussion of how much you can jack up your rent to take advantage of this strategy. All right, I want you to understand one of the constraints here in segment 5 of this is understanding passive activity rules. Passive activity rules. This is getting a little bit into tax 201 from 101, so try to follow me on this. Again, I'm not trying to make you a tax CPA. I'm trying to make you an intelligent financial business owner. That's what I'm trying to do. And my belief is every CEO needs to understand enough in each of the modules of their business to make intelligent decisions in each of them and across them. Intelligence in marketing, intelligence in practice management, intelligence in billing, intelligence in finance and accounting, and intelligence in investing. Again, you don't need to understand 100% of it, but I'd like you to understand like 20% of it so you can understand these concepts, because most of you got to go to a CPA who's not going to do the work of creating a comprehensive plan, because CPAs are siloed in their tax area and their accounting area, and that's it. They're not specialists in cost segregation. They're not specialists in 401ks. They're not specialists in retirement planning, in budgeting, and personal finance. They're not specialists in all those categories. And then you have people who specialize in some of those who don't understand accounting and tax. And that disjointedness creates massive complications for doctors. And it's one of the biggest reasons why doctors don't get ahead financially.
Do you ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, Practice CFO, just for you. With almost 2 decades of experience, Practice CFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the x-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or chief financial officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
Hence the reason why I started Practice CFO. I only work with dentists so that we can cover the landscape and be specialists in these areas unique to a dental practice. I don't need to know all the areas of the tax codes for a telecom company or farming or manufacturing company. No, I don't need to. I only need to know all the areas of the tax code across a broader spectrum that relate to one specific type of business, a private healthcare practice owner, i.e., in this case, a dentist. We do have a few medical doctors, but we are 95% dental. All right, so now with that sort of backdrop in mind of why I want you to stay plugged in here to this episode and understand what are passive activity rules. Passive activities rules are the following. Your income and expenses are classified as active or as passive. Now, this can get complicated, but again, I just want you to understand kind of the highlights. Passive losses. LLC rental losses. So when you buy your building and you own your LLC that owns the building, these are called passive, and they can only offset other passive income. But, and this is an important but, they offset the passive rental income dollar for dollar. So the rent you collect in your building LLC can be tax-free at the LLC level in the early years if you have that ability to deduct that rental income. So the rental income coming in from your dental practice is called passive income. And the net income or the expenses in your LLC are passive expenses. So they offset each other. However, you cannot use any losses in your building LLC, net losses for the year, to offset your W-2 from your dental corporation or to offset your K-1 from your dental corporation. It can't even be used if you are owner operated, meaning that you are the one in the space. You as a dentist are the tenant and the landlord. That's called owner operated building. You cannot use your passive losses from that building LLC to reduce other passive income outside of it. Like, let's say you own a real estate property down the street that you don't operate in. It's a third-party renter. And let's say that one has net income. You can't offset your dental building losses against that third-party rental income. You're not allowed to do that because you are an owner-operated. You are the tenant in the building that is receiving the rent from your dental practice. And so there's some limitations there. But the key thing here is any rent you pay from your S corporation to your building, you can offset that rental income by any expenses in your building LLC. Now, there's one caveat to that. If your adjusted gross income, it's not quite your taxable income, it's close to it. If your adjusted gross income is under 100,000, you actually can deduct $25,000 of losses in your building LLC against your W-2 and K-1 income from your dental corporation. Now, since the vast majority of you, and I hope all of you, you have income over 100,000, because I don't know how you'd make ends meet with your student loans and all the life and toil and blood, sweat, and tears you put into getting your dental degree and buying a practice. I certainly hope you're above $100,000 of taxable income. So I'm going to say for most of you, this little caveat does not apply. Here's the caveat that I find very interesting, and I've had many doctors ask about this. Okay, what if I could classify myself as a real estate professional? This is a specific term in the IRS tax code that says real estate professionals who do real estate management for their living. It's their job. It's the primary way that they source their gainful employment is they're real estate professionals. They may be a broker, they may be an agent, but they spend at least 750 hours a year. And that 750 hours is more than any other professional thing that they do. They can be considered a real estate professional. And if that's the case, all of the losses in your building LLC, 100% of them can be used to offset as much other W-2 and K-1 from wherever and net those two. So if you do a cost seg and you pair that up with bonus depreciation and you have $400,000 or $500,000 in year one of a deduction, and let's say you have a $500,000 W-2 from your corporation, this is just a hypothetical, you could net those two and not pay any taxes in that year. So a lot of you are going to say, well, why don't I do this? Well, I'm going to emphasize what I just said a moment ago. You have to spend 750 hours a year, and you have to do that real estate work more than your dentistry, which is why the vast majority, pretty much all of you, are not going to get this. Unless you have an S-Corporation dental practice that is 100% run by associates, and therefore you literally spend your primary job is managing real estate properties, then you could take your losses from those real estate properties and offset your S-Corporation income. But again, that's extremely rare, and it's extremely difficult to have 100% associate-run dental practices. Very, very, very difficult. I almost never, ever see that a successful strategy. Now, here's where it could get interesting. You have a stay-at-home spouse. They get their real estate agent's license. Very easy to do. And they don't actually have to have their real estate agent license, but it sure does substantiate, because this very much could get audited, it could substantiate the truth or the reality that your spouse is acting as a real estate professional. And if they spend more than 750 hours a year and it's their primary way of sourcing income, let's say you have a few real estate properties, maybe some are Airbnb properties, and maybe you're not paying a management company because your spouse is dealing with maintenance calls and vacancies and collecting rent and the accounting and all that stuff. Now that is a real estate professional, and because you're married, you can then offset income from the dental practice by the losses of your building LLC. And it is a huge win-win. I mean, it is a massive win-win. Now, I will say one caveat is to make sure to talk to your CPA in your state. Make sure your state allows this as well. There's certain caveats by state, I believe. So talk to your CPA about your specific passive activity position before building this strategy out. This is not a do it at home on your own type of strategy. Trust me, pay for some guidance on this one before you execute a plan. So I want you to understand what passive activity is, and your building LLC is a passive activity entity, and therefore it limits how much of a loss you can deduct on your personal tax return, with the exception of those two caveats I just mentioned, the under AGI 100,000 and a more advanced spouse as a real estate professional. All right, with that one, everyone, I'm going to wrap up this episode where we talked about the warnings of not holding your building in your S-Corp, the structure that makes sense between you as an individual, your dental S-Corporation, and your real estate LLC, and then lastly, understanding passive activity rules that may limit the benefits of doing this. Stay tuned for the next episode when we'll get into a more specific example and what rent might be reasonable for you to pay to maximize the benefits of this strategy. Thanks for joining, everybody. Until next time.